Hello and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I am joined today by Tom Hibbert from our Chief Investment Office.
Morning,
Welcome.
everyone.
Morning.
Good to be here.
The idea behind this podcast, if you've not listened to us before, is to have a little chat based on our weekly markets review that we send out to subscribers on a Monday weekly, and just get into some of the more interesting areas in a little bit more detail, really to try and make them more accessible and help people understand what it is we're talking about and thinking about. So the idea is grab a coffee, plug in your ears and listen to us for about the next 10 minutes to find out a little bit more about what's going on in the markets. This week, Tom, we are going to follow up on the conversation I had last week with Richard Champion, when we were talking about not being complacent and being extra vigilant about what's going on in the world. And this week gave us a really good real-life example for that extra vigilance when we saw the US-China trade spat. And that was an external trigger that impacted the markets. So on Friday, the markets finally stumbled as trade tensions reignited between the US and China. I think global equities fell about 2.1% altogether last week.
Yeah, that's right.
So I just wanted to know from you, sort of why now? What's kicked off this spat at this particular point in time? Because this sort of underlying uneasy truce has been going on for quite some time. So what's kicked it off?
Sure. So since mid-April, equity markets have really recovered off the back of some trade agreements, and there was a big trade agreement with, or at least the shell of an agreement between the US and China.
Yeah.
And the two countries have, been operating on good terms since then, but they still had a lot of negotiating to do. And there was a meeting scheduled for the end of this month between President Trump and Xi Jinping. And running into that, China decided to turn the screws up a little bit last week.
Okay.
They're very dominant in rare earths mining and processing. So China account for about 70% of rare earths mining, 90% of processing.
And rare earths mining, that's...
Many of the raw materials that are very important for national security, military technology, and things for AI and the productivity boom. So
for processors or data centers or whatever.
Exactly,
Exactly.
Yeah. So after that, Trump reacted very aggressively.
Yeah, as is his style, I guess.
As is his style. And he threatened to pull out of the meeting at the end of the month altogether. And then he also put on 100% tariffs on all Chinese imports to come into effect on the 1st of November. And he also put controls on critical software exports to China as well. So it was Trump's reaction that raised the heat up even more, that triggered the volatility on Friday.
So really a bit of posturing by both sides going into the talks. And that's why it's happened at this particular time.
That perhaps unnecessarily raised the tension a little bit in the heat.
Understood. So the cynic in me would say that China's been working towards this degree of control over the Western world for years, and really making us, and all of the tech companies, I guess, dependent on their rare earth resources and their processing capabilities. So how does this play into this sort of more macro environment and the move away from globalisation and interdependency on other nations?
I think they have to. I mean, the two countries have become totally reliant on one another. I think particularly that's ramped up since China joined the World Trade Organization in 2001. They joined with very favourable trade terms.
Right.
And global trade flows have now become very asymmetric. It's what Neil
asymmetric, meaning?
So basically the US spends and consumes and China manufactures and saves.
Right.
And that makes the US vulnerable in terms of its supply chains, manufacturing reliance on China. And China is also reliant on that US investment as well. It supports their economy. So it's a two-way thing, and it's not sustainable or sensible really either way.
Because neither of them trust each other.
Exactly.
Okay.
And it's one of the reasons why ultimately I think de-escalation is likely for now. We're already seeing a bit of that, although it's certainly not resolved. But it was obvious early in the year when the two countries were mudslinging, when the trade war first was escalating, it became immediately apparent just how much damage they could do to one another. Both sides have thresholds. So the US could raise tariffs by too much and then it just hurts themselves. They can shoot themselves in the foot. It might not produce additional revenue.
Right.
It can have negative effects on their economy. And then China as well, they don't want to get into a trade war. With their economy, they're struggling with domestic demand and deflation. So it's a bad time for both countries.
Yep.
And altogether, although there is a risk that this escalates further, I think both sides have a imperative and a drive to avoid those pain thresholds that they have and de-escalate. So,
a vested interest, I guess, in de-escalation.
Exactly. And while China has a higher pain threshold politically,
their
economy is arguably on a more fragile footing, so it kind of balances things out.
So let's get back to the markets, and in particular the US tech market. And what was the impact of this spat on their valuations in the short term, and what do you think about the long-term outlook?
Yeah, so the most severe impact was on, it was the areas most affected, as you would expect.
Yeah.
So US tech fell 4% on Friday. Chinese equities also fell about 2.3%. And also, given the broader implications of an escalating trade tensions, it was sectors that are more tied to the economic cycle. Cyclical sectors that underperformed. So consumer discretionary, energy.
So consumer discretionary, sorry, what does that?
Those are consumer sectors where they don't need them to.
So discretionary spend.
Discretionary spending, rather than consumer staples where you need it, and that's more defensive. So those defensive sectors, healthcare, utilities, consumer staples, all held up pretty well. What really, I think, the impact of this was, it's just on the back of a few months of very strong equity market performance.
Yeah.
So it reminded investors that there are those downside risks to equities are there after those few months of very strong gains. You look at the fear index, the fear gauge, the VIX, which is a measure of uncertainty and volatility in equity markets. That spiked last week, and it remains a little bit elevated. That, I think, shows that the equity market is on a little bit more fragile footing at the moment. But altogether, it's only a small stumble.
Yep.
The bigger picture is still very much the same, and the one that Richard painted very eloquently last week, that yes, valuations are stretched in places, but they are supported by a very solid backdrop, a solid earnings backdrop, a solid policy backdrop. And those valuations can be supported as long as those fundamentals remain strong, as long as the earnings growth is there. And as long as the economic environment remains benign. And so far, that still seems to be the case.
Okay, thank you. So let me sum up what's in my Canaccord takeaway coffee cup this morning. So markets are still generally continuing on their upward trajectory. They can be vulnerable if something external triggers it. And the US-China trade spat is one such reminder, but only a little small spark, a little small spat that just reminds us that we need to continue to be complacent, not to be complacent indeed. We need to be alert to these shocks. And as you remind us, and Richard Champion reminded us last week, that's the main takeaway really. Stay invested, stay balanced, and stay awake.
Yeah, balanced, diversified and flexible. Is that what Richard said last week?
He did
balanced,
say
dynamic and flexible.
I got key messages coming out of the Chief Investment Office. It's brilliant. All right, thank you very much indeed. Thank you for your time, and look forward to speaking to you again next week.
Thank you, everyone.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.